If it works, it works. If it doesn't, it doesn't. But we'll always have the audio.
That's right.
And that's the most important part. All right, you guys ready?
Yep.
So, I have a little intro, and then when I say welcome to, I'll say who you are, Richard Davey of Fiduciary Financial Group, and I'll say, welcome to the best of investing, and that's when you can say, thank you, Edward. And then I'll just get right into questions and stuff.
He's really good. He makes it flow and it's fun and easy. It's like over before you know it.
You'll notice that I'm pretty nervous.
No, you're awesome.
But you do need to be about that close.
Okay.
Yeah, you really do.
Yeah, exactly. Because for this thing here, I
Unless you're sneezing.
Yeah, that's right. You have to cough, whatever you
And I'm preaching to the choir here, but don't move around too much.
Yeah, that's right. Yeah, sometimes I kept bouncing with the hand. I go, don't do that, I get to the stuff. Yeah, there you go. That looks good. All right, away we go. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Patti Cohen of Pacific Union International. Mark Hunt is off today, but I've got a deal of the week to talk about. Our phone number is 888-912-1190. You can use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. And that certificate is not sponsored by the radio station, but by Tan Bella Tanning Salon, with 2 locations in San Francisco and 1 in Marin. The weather's going to change here pretty soon, so you want to get your tan on. All right, today's trivia theme is random trivia. Now, our special guest in the studio is Richard Davey of Fiduciary Financial Group. Richard, welcome to The Best of Investing.
Thank you for having me.
You're very welcome. Now, you are a CFP.
Yes.
And if I remember correctly, you also were or are a CPA?
Correct.
Okay, that's a good combination.
Exactly.
Right. And since you are a CFP, an email came in to us I thought would be right up your alley, and it says clients keep asking if they're better off owning index funds. So maybe you can kind of compare those with regular mutual funds, ETFs, and all that kind of fun. Educate us.
All right. Well, I'll start with educating. So an index fund, starting out with what it is, most common one would be a fund that tracks the Standard & Poor's 500 index.
Okay.
It's 500 of the largest companies in the United States, and there are tons of ways to invest in funds these days that just track the movement of those 500 companies. So an index fund is not managed using an active manager, where you typically, in a normal mutual fund, would have an investment person, usually a chartered financial analyst, who will pick and choose different companies to include in their fund based on their financial merits. An index fund doesn't do that.
Okay, so it's sort of like just investing in the stock market.
In the stock market,
Okay.
Broad exposure, yeah. So it's obviously a tough topic. Lots of debate goes around. There's a lot of money at stake. Active managers don't like index funds because they want to prove their worth and get paid for managing funds.
And then I also got about with robo-advising.
Correct. That's actually more of a platform
Okay.
to allow an investor to easily and inexpensively invest in a broad array of funds. So it could be active or passive funds. Most of them use passive index funds. Passive meaning no active selection.
Okay, and I got to think that the fees are going to be low because of that.
Usually they're pretty low. Fintech's a booming business right now, financial technology, and you have loads of robo-advisors coming out. But you also have companies like Vanguard and Schwab who have their own robo solutions as well.
So are you a person that gets your fees based on the trade or a flat fee for managing?
Great question.
Or percentage of assets under management?
Yeah, so there's really 3 ways to get paid if you're in our business. There's commission, where you get paid via transaction. There's a fee on the assets, usually around 1%. For a human advisor, and then there is hourly. So a lot of CFPs now are providing hourly consultations for people who want to do some mixture of DIY, but also have some handholding process.
I'm going to guess that the ones who just charge hourly probably don't make quite as much. I mean, how much can you charge per hour?
That's the hard part right now. I don't just work on an hourly basis because honestly, I haven't seen how you can make a reasonable living doing it. unless you're charging a very high hourly fee.
And there aren't too many people who are willing to pay, $500 an hour or something.
Correct.
Right, and the other side of it is too, they're paying for your expertise, because sometimes I'll sell a house and it looks like I put in like 4 hours, and then, well, you did that so fast. I go, well, actually, it took me 28 years.
Yeah.
Yeah, exactly.
Yeah, how do you bill for the time reading about the market, understanding the market, following the news? That's not billable to a client.
Well,
Exactly.
here's something funny is when I first got my first job as an accountant in San Francisco, there was a banker who had his master's in tax. This guy knew more about tax than anybody I've ever known. And one time I walked into his office and he kind of held up his finger and goes, hold on a second. And I just listened to him, listening to a client talk, and I didn't hear what the client said. And after about a minute and 20 seconds, he just said, yes. And then he hung up the phone. And he looks at me and he says, and this was back in 1982. And he goes, that phone call just cost that guy $500 just to say the word yes. And we had some tax transaction where the client needed to know whether it was a yes or no.
Yeah.
Based on certain transactions.
Complicated stuff, but then you can really look at the value, and people like you save the money.
Well, it's the same thing with certain attorneys where they've put together, let's say, a prospectus, and it costs $70,000, and then the next person comes along and says, "Well, you've already got the boilerplate," but it's like, well, no, you still have to pay the $70,000 for that too. I'll tell you what, we're going to cut to our first commercial break. We're in the studio with Richard Davey, who's a CFP, also happens to be have his CPA license. Is it still active?
Yes.
Oh, very good. Yeah, you don't want to let that go. You worked too hard for that one. All right. We're talking random trivia here, and if you know the answer, Richard, don't answer yet. We'll let you answer when you come back. All right. Which Soviet leader approved the building of the Berlin Wall? That's our question, right? Which, by the way, you know what? Putin apparently just passed the longest tenure. Next to Stalin or something like that.
How long has he been?
Like something ridiculous, like 18 years.
Oh,
I didn't realize that.
Yeah.
Okay. It's all Bush's fault, or it's all Trump's fault, or all Obama's fault. Who knows? Okay. Call 888-912-1190 to answer this question. If you're the first caller with the correct answer, you're going to win that 5-pack tanning certificate, which, by the way, they have lots of services. It's not just getting tans. You can get rid of your wrinkles, too, all right? Which Soviet leader approved the building of the Berlin Wall? Don't touch that dial. The best of investing is going to be right back.
Well, I can think of this. Khrushchev, which was so long ago. I don't know. You weren't even born. I was probably whatever.
Approved the building, though, of the Berlin Wall.
Yeah.
When was it built?
I don't know. I don't know.
50s?
I thought it was 1960. I think
It would have been Stalin. Who was after Stalin?
Oh, I don't know. What was Khrushchev? I don't know.
Well, you can guess whatever you
Most Americans don't even know who's president. Oh, well, this time they finally
This
do.
time they do, yeah.
This time they do. Yeah.
whether they want to or not.
I feel like we're all in one big reality show. Like,
Yeah.
Trump's obsessed with everyone talking about him all the time. Well, guess what? We're all doing it.
Yeah.
There are those little puppets, and which is
He knows how to promote.
yeah, you know.
That's true.
And like they say, no publicity is bad publicity because he just wants the attention. And he's certainly getting it,
Mm-hmm.
and it doesn't matter. You know, when he mocked that person, I thought it's over for him. And then the whole thing and the seeing all that, I was like, oh, it's over for him.
If you want to upset them, just don't talk about it. Don't do
Yeah.
anything. You know, just ignore them.
Savage, very savage. Anyway,
Okay.
it was fast, is it?
Yeah,
insane.
Yeah, that was our first segment of 6 minutes and 40 seconds. Okay, I'm back to make a mention of the point board here. So we need to finish off the question.
Yeah.
Because you were talking about like what they are, but you know, what's your advice about?
I'll just basically say they're a good starting point.
Okay,
Yeah.
that's fine. Then we'll move on to Patty. We'll go back and forth.
I have a question. I don't know if you know the answer, so I don't want to ask you a question. I don't know the answer to. Somebody was telling me about this app called iBillionaire, and it'll text you when somebody big, like, you know, Buffett, Gates, whatever, does a trade.
Huh. That's really cool.
And so you're like, okay, on it. But the
That's a
way
really good idea.
as fast as everything happens, you're really behind it anyway.
Well, my son's friend,
That's a good discussion.
I think he and his dad invented something called like Acorn or something. And what they do is it's a way for you to, like, if you have extra change, you can invest it in their index funds. But we're talking about $1.20, and they have like 400,000 members.
Wow.
And it's a very good place for like kids to start.
That's very cool.
It's a nightmare.
Change. I know.
Doesn't it?
Yeah,
I know.
How on earth
But they've got,
did they
I don't know how many millions, right? Because some people have, a few $1,000s. Some people have a few hundred.
I mean, I'm thinking about things like governmental regulation and all that, and
It's the Wild West.
reporting and all that. Do you have to, anyway?
FinTech is going to have some big shakeup because there's no regulation.
Okay, we'll see that. We can talk about that.
Okay.
I don't know a lot about it other than they're
It's okay.
saying things that the traditional firms wouldn't be saying in their promises and their advertising.
Oh, wow. Well, crowd.
And we can make these points, yeah.
Okay, here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Patti Cohen, Pacific Union International. Our first trivia question was a history one. Which Soviet leader approved the building of the Berlin Wall? Go ahead, Patti.
Did I say it? Khrushchev?
Khrushchev, Nikita Khrushchev.
You said it.
Very good.
Yeah.
Figured
Wrong.
since I knew that you knew the answer, I figured I'll let you answer that one.
Fine.
All right, so Richard, before we get back to you, I want to make a mention here for come aboard Hornblower Cruises for a one-of-a-kind dining experience, spectacular views, and live entertainment. You guys ever been on Hornblower?
Haven't.
I have years ago. It's awesome. It's
Yeah, it
fun.
goes underneath the Golden Gate Bridge. I mean, it is. I gotta say, the food is excellent. The entertainment's usually pretty good, and the champagne was incredible.
They
Love
pass
it.
out
Yes.
Dramamine?
What's that?
Did they pass out Dramamine?
Now, you know what? You don't really get seasick on it, even though you go. In fact, what they do is when they go on the Golden Gate Bridge, if it starts to get a little bit choppy, they'll just turn right around. And I'm the kind of guy who gets seasick,
Yeah.
but I've done fine on Hornblower.
Huh.
So check them out at hornblower.com. All right, so we are in the studio here with Richard Davey, who's a CFP and a CPA. We never actually did finish the question here. So, are people better off with index funds?
So I would just conclude by saying that they're a great building block for a portfolio, but the people who say, index for everything, I think that's oversimplified. There are areas that just aren't proven yet with indexes. And even an index fund is a man-made decision. What goes into the index is an active decision. So the debate of whether or not to make an active investment or a passive one is kind of an imperfect question because every index has humans behind it building it. So,
well, that's a good point because back in the old days, one of the first companies, I don't know if it was one of the first, but there was a company that was in the Dow Jones Industrial 30 that made buggy whips.
Oh. And
I don't think they're around anymore.
Exactly.
And so over time, companies have gone in the index and out.
Yeah.
If their stock is just too low and their company doesn't seem, who are the newer type companies that made it in that weren't there 30 years ago?
Yeah.
Right?
So many.
well, and then which index do you pick? I mean, the S&P 500's roughly doubled in the last 10 years. Your money would have doubled.
Okay.
And the Euro Stoxx 50, which is the 50 largest European companies, your money would be about flat 10 years later.
Wow.
Wow. That's
So,
another lost
again,
decade, like between
yeah.
2000 and 2010.
So what index you pick, how you pick it, how you build an index, those are all active decisions essentially. So
I
it's a starting
know a
place.
lot of people when the first thing you think of an index fund, you just think of the S&P 500.
Sure.
I think that's what most people. But should you have a little bit of Euro type stocks or some kind of index or something because we are a global community nowadays.
Yeah, absolutely.
I say invest in real estate.
Yeah.
You can leverage it.
Yeah.
Yeah.
Well, you've done very well in real estate too. Okay, so let's see here. Moving on, Patti, let's go on right to you here. Okay, so we got a question. It says, when looking for a house, should I go for the most house I can afford?
Yeah, I mean, it's a good question. It depends. I mean, if it's a first-time buyer and they're just so maxed out and stretched, I think you always have to have a cushion.
Yeah.
And in fact, the lender often requires it, that you have some reserves. And at the same time, like, is it a fixer-upper you're going to want? I mean, I literally had a client, I'm a first-time buyer, but ask me, so I can use my money, right? And I'm like, no, your money's in the house. And if you want to use it, you're going to have to sell that house or you're going to have to refinance. And when you refinance, you'll get your money, but you're going to be paying interest rate on your money.
Gotcha.
So it's basic, but they didn't know that.
Well, when I owned a condo before and we were buying our first real house, I had to, I couldn't just max it out because I couldn't afford to carry both, and I didn't want to put myself behind the 8 ball.
Right.
So it was like, you gotta make sure I gotta give myself just a little cushion because there was a house at the time we just loved, but it was 700,000, and that was a lot.
That was a lot
That was
back
a lot.
then.
Yeah. So we only afforded the house for 393.
Yeah.
You know, but
Yeah. Well, I mean, it's sort of, I don't know, it just speaks to a little bit about like just that kind of question. You almost want to like go through the basics also, like buy the worst house in a great neighborhood.
yeah.
But even if you don't have kids, buy a house with great school district because you want to be looking at appreciation long term.
Good point.
And usually a first time buyer would be thinking like that way, should I use all my money? Because as you age, you have more assets and you sprinkle it around and all that. But a first time buyer should be kind of looking at this house as a stepping stone into the next.
Okay.
And it's like, so the question is, what's going to get me equity? And you're going to give up some stuff in the beginning. Don't go for your dream home in the not so nice neighborhood.
Yeah.
It's not about the house, it's about buying it correctly.
Good point. Thinking about this too brings me to another question. Are you seeing that a lot of empty nesters are downside? I mean, the typical thing was, in the last 15 years or so, it seemed like, all the kids moved out, and so too big a house, and now we're downsizing. That's still going on.
Oh, it's going on more and more. It's
Really?
going to be going on even more because of the baby boomer and the aging population. And not to mention that brings us to one-story homes are so in demand.
Oh, yeah, people, as they get older, they don't want to climb steps.
Right.
Yeah.
And here's the thing too. People like mid-century modern and younger people want one story. And the mid-century modern is really in right now. That's one
It's
story.
like an Eichler.
It's like an Eichler,
Yeah.
really in.
But what about the kids who have moved out and then they came back? You have to keep that extra spare bedroom.
All the more reason to downsize.
Yeah.
One way or another, they gotta leave.
I love you kids, but sorry, we don't have any room.
I know, exactly.
All right, think about, boy, this goes fast. We're going to cut to another commercial break. We come back. Richard and I were talking off air. He's got a great strategy about using options on stocks, but in a conservative way. So, and we want to ask him about that. All right, so here's our second trivia question. Which of America's original 13 states took its name from Elizabeth I? You only have 13 states to think of, right? And New Mexico was not one of them. So don't answer that one. Okay. Call 888-912-1190 if you're the first caller with correct answer. You're going to win that 5-pack tanning certificate from Canbella. Which of America's original 13 states, or 13 colonies, let's say, took its name from Elizabeth I? All right, that's our question. When we come back, we're going to ask Richard Davey about using options in your portfolio. All right, don't touch that dial. The best of investing is going to be right back.
Given that I'm from the East Coast, I should kind of know that.
You probably name all 13 of those.
I could.
Then what?
Yeah. Well, I mean, there's Elizabeth, New Jersey, but I don't know. That's the city of New Jersey. I mean, there's Vermont, New Hampshire, Massachusetts, New Jersey, New York, Connecticut, Rhode Island, Maryland.
Good. And you're not allowed to guess all 13.
I'm from 13. I'm from 13. Delaware. Did I say New Hampshire? Maryland, Delaware, New Hampshire, and I guess Virginia and
Carolinas.
yeah.
Were they
Yeah.
both 13 or?
I don't know because I come out 10, so it might be Carolinas. So what has to do with Elizabeth?
Was Georgia one of the first? Yeah.
Yeah.
I have no idea.
Yeah, or Pennsylvania, but I don't get it.
I don't get it either.
Yeah, ready?
All right.
Can I ask a quick question?
Yeah, of course.
So I don't want to make this commercially, but should I reference what I do with clients?
Absolutely.
Oh, yeah, yeah.
I didn't know if I was allowed to do that.
Sure. We're not an infomercial, but we definitely want to promote.
Okay, just checking. Cool.
In fact, what I'll do, Patti, I'll ask you about, people asking you about real estate so that you can give her information, then we'll
Sure. That's
go on
fine.
to you.
Yeah. I mean, I can talk a little bit about just what's happening, like let's see, income needed to purchase has doubled over the last 5 years. Prices rose in all nine counties. U.S. prices have been rising for the 60 states, sort of
Okay,
61st.
so I tell you what,
Yeah.
instead of going to you first, let's finish off with him, then we'll go to you.
Sure.
You
I don't have much to say.
I wanted to give a plug too, based on what you're saying, that basically every financial plan I do for people with less than a $3.5 million net worth is they need to sell their place and rent. Flat out. It's very simple math. That's where everyone's net worth is.
Because they're older people.
Yeah,
Yeah.
and all their money's in their house, so they have to either use a reverse mortgage or sell their house to fund
Which is
retirement.
exactly ties in with the question and what yeah.
Okay, ready? Welcome back to the Best of Investing. One more time. I'm Edward Brown, your host, along with Patti Cohen of Pacific Union International. Second trivia question. Which of America's original 13 colonies took its name, the states we're talking, took its name from Elizabeth I?
Maryland?
No. Virginia.
Virginia.
Not sure how that happens. Elizabeth and Virginia are two different names, but
No idea.
and listen, I saw it on Wikipedia, so it's got to be true. Okay. So Richard.
It was a Russian source.
Yeah.
Right.
Oh, you're going to be good to have on the show again. Okay, so Richard, we gave the audience a little teaser information about using options in portfolios. Give us a little background. Tell us.
Yeah, so an option can mean a lot of different things, but just know that with every option contract, there's usually a speculator and there's a hedger or a risk reducer. So my pet peeve is when someone who should know better, like a CFP or a CPA, says, oh, well, options are risky. My client shouldn't be doing that. And it's such an incomplete answer because yes, for the speculative side of an option contract, it's absolutely not appropriate for most investors.
Okay.
But what I do, covered call writing, is owning a stock and selling a call option against that stock for additional income. And
Give us an example.
sure, so an example might be stock A trades at $100 a share. And you might say, okay, and within the next 6 months, I'm willing to sell that stock that's trading at 100 for 105.
Okay.
So if it goes past 105, too bad for me, I'm still selling at 105. I get paid for that commitment. That's called a premium. So it's a covered call contract because I own the stock. That's the covered piece.
Yep.
I'm selling a call option, meaning the right to buy at 105. I'm getting paid a premium for that.
And that premium would run depending upon
Totally
the time.
depends on the time, the volatility of the stock, things like that. But I've had really good success attracting clients with that type of strategy because in Marin, an expensive place to live, people need more income off of their portfolios to live.
How much income are you generally deriving from that kind of strategy?
So I would say on a general stock, you're looking at between an extra 3 and 6% yield off of the stock by writing call premiums. It can be more, it can be less, but in general, you're able to add 3 to 6% extra on top of the dividends.
And are you writing them way out of the money or just barely out of the money?
So out of the money, meaning that 105 over current price of 100. That would be 5% out of the money. I'm typically writing between 5 and 15% out of the money.
Okay.
So it gives me a chance to let the stock run a little bit, make some money if it goes up. But I do cap my upside in return for more income. And, most baby boomer investors are fine with that. They'd rather get more income.
So in theory, the best thing that would happen would be the stock runs up to 104 and then the option expires, comes back down, and you keep doing it again.
You just keep ringing the cash register, yeah.
I know. The reason I like talking to Richard,
It's a curse.
I know, Richard about this is I did this back in the late 70s, early 80s, and I was making 20% a year.
Wow.
Because I bought the stock and just kept writing the option. It ran up, came down, ran up, came down. And well, this is easy pickings,
Yeah, I mean, there's still risk, obviously, and you don't always, hit home runs, but it's a way to increase income from your portfolio, which is why a lot of people like it.
And since you appear to be an expert on this thing, how do people get a hold of you if they wanted to talk more about this strategy?
Sure. So my company is called Fiduciary Financial Group. It's in Santa Fe. Phone number is 415-785-3778.
Okay. They can always write into the Best of Investing, and we'll pass your information on.
Sure.
Patti, you had a couple more statistics for us there.
Yeah, I mean, the big question all the time is, how's the market doing?
Sure.
Where are we going? One side says it's pretty frothy, and it's the 65 straight consecutive month of rising appreciation. We're getting into the like second longest period of economic prosperity in the country ever. So are we coming toward a buyer's market? That's one side. And I, like even if we are waving into that little buyer's market, it's not going to go down like it did last time. We have prudent lending practices. We have a really strong job market. Yeah. But so that's one side. The other side is, you know what? It keeps going up. And if you look at the curve, it's on a same continuum as if, we went down, of course, with the Great Recession. But if you just look at that line, we're still on track. Okay. So I keep getting surprised, and it keeps going up, and it's still a buyer's market. And it's hard to tell. Like this is our second seller's excuse me.
I want to make sure I have that right. Okay.
Yeah, still a seller's market, okay. And this is our second selling season, like mid-September to mid-October, and it's pretty busy. Still hard to tell how it's going to really go, but it seems to me that the sky's not. It doesn't seem to me the sky is not falling. And it's still very strong. And in fact, all 9 Bay Area counties had price increases over the last year. The income needed to purchase, however, has doubled over the last 5 years. So you get into the affordability with quotient, which is 10% or so. That's really scary. But anyway, and of course, obviously in this country, the biggest down payment needed is in the Bay Area. But we have a really strong job market. So it's what's happening, but it's still a seller's market.
Interesting.
Yeah.
And before I forget, people who have questions on real estate?
Yeah, feel free to call me. I work with people for a long time, sometimes before they buy, and sometimes it just pops like that. So I'm patient and I like to educate however it works. My name is Patti Cohn. I'm with Pacific Union in Marin County at 415-722-4842. Okay.
And Mark Hanf of Pacific Private Money is not here, but I do have another deal of the week that kind of fits all very similar to Patti, what you're talking about, the affordability. So again, that's the same situations we had a lot of times. People want to buy a house, they haven't sold their existing house, they don't want to move twice. And usually, unless they have lots and lots of income and lots of equity, they just don't qualify for buying the second house without first selling the first house. So what Mark does is Pacific Private Money, they will cross-collateralize and use both houses, the new one, and put a second deed of trust on the old house in order to give them enough money to buy the new house outright.
And that's hard to find.
Yeah, there aren't too many lenders, especially owner-occupied, because there are a lot of hard money lenders out there who will only do investment property. So Pacific Private Money is kind of special in that way, in that they've gone through all the licensing and Dodd-Frank rules and regulations and all that in order to correctly and legally do owner-occupied financing. And sometimes they'll do long-term. It doesn't have to necessarily be short-term. Mm-hmm. But most people want to pay the loan off quickly and with conventional financing because it's a lot cheaper. Mm-hmm. So call Pacific Private Money if you have a need for this short-term financing at 415-883-2150, or go to pacificprivatemoney.com and see if they can help you on that. Okay, and let's see here. We are going to cut to another commercial break here. I know it goes fast. It's kind of an interesting, weird question. Who was the only clean-shaven president in the 50 years between Grant and Taft? Right? So Grant was what, 18-something?
I was going to ask you for the years.
Yeah. Well, Grant came right after the Civil War, right? And Taft was what, 1919 or something? That's our trivia question. So, who's the only clean-shaven president? Yeah, it's kind of interesting. Now everyone's clean-shaven.
No softballs.
I'm not going to strain my brain.
Call 888-912-1190. I guess you have to Google all the presidents' faces to figure out which one that is.
Yeah, just images.
Images, okay. And when we come back, also, I want to let people know the rate of return that Pacific Private Money paid on the last distribution. I was very happy indeed.
Yes.
All right, don't touch that dial. The best of investing is going to be right back.
Right.
Did you see your last?
It's nuts.
You don't have to be. Yeah, and you don't nothing to be nervous about, right?
No.
Yeah, no.
It makes it so simple.
I'm sorry, I've got to look at the answer to this question.
Yeah.
All right. Have pictures.
I like the name of your company. That's really good.
Thank you.
I'm surprised somebody doesn't have it.
I know. We weren't able to trademark it nationally, only state, because it's too generic. Oh,
I mean, the word fiduciary, if I mean, are you, do you have that, is that just a generic term or?
no,
You actually, because I know Chrissy is a fiduciary and.
yeah, so there's professional fiduciaries, which are actually, it's a licensed designation, which CPAs don't have to be to do everything a PFAC or professional fiduciary does. But fiduciary and investment advice means that you're held to the fiduciary standard, which is you just have to act in the client's best interest.
Okay. I mean, it's kind of.
Seems like it.
It appears that that's supposed to be prudent man
would
rule
think.
type of thing, yeah.
But at brokerages, they're not.
No.
They're held a suitability standard, and so as long as something's a suitable recommendation, so there could be a substantially better option. You can't sue them because it's suitable. Whereas if I have two options, I'm not paid any different anyway.
Yeah.
And I just recommend this one over that one, I'm liable.
Yeah.
If I had understand or knowledge of the two.
I mean, it seems obvious, but the truth is, not only are they not necessarily going to give the best option to the client, but their first responsibility is to the company they work for.
Sure.
Yeah.
That's why being independent's huge.
But so did you have to do something specific to use that name fiduciary?
You have to get licensed with a 65, but being a CFP holds you to the fiduciary standard too.
Gotcha.
Yeah, so you say that it's fiduciary oath when you're a CFP.
Okay, so the reason you could use that name, that in your name.
Because of our business structure. Yeah, because we're an RIA.
I mean, it says trust,
Yeah, it does.
experience,
We could
honest,
form a real estate division.
group,
I'm just saying,
substantial.
we could
Yeah.
form a real estate division.
Wow.
I've thought about that. But having a real estate investment would be a huge benefit.
Yeah.
Yeah.
All right.
Okay, so I do want to talk just a little bit about the rate of return on that, and then
Do
what
it.
else do we want to cover?
How much do we have left?
We have one long segment of at 9:17.
So one thing I'd like to pitch for planning to buy a first home is call it conflict of interest of the investment industry to get people to max out 401ks at all costs, despite the fact that sets you up for a horrible situation when you're trying to buy your first home because you have no liquid savings. Because I'm seeing it over and over with young people that can't buy their first home.
Really good.
Because they put all their money in the 401k.
Yeah, so you hear the millennials coming back to their parents all the time. It's like a lot of them have 100 grand in their 401ks. They just don't have anything liquid.
Well, you know, it's interesting though. I mean, I plan to do that for my son. Exactly for that. I would rather see him, because it might as well just come from me. I'd rather see him sock away as much as he can pre-tax, and I'll be there to help him out.
I mean, that's a good luxury, but yeah, if you
Not
can't,
everybody has that.
Most people can.
Yeah.
so you need to save liquid.
And you also, like, by the way, so just for viewers, you have to be really specific sometimes. So therefore, if you do take out that money, not only are you forfeiting this, there's this penalty and 50%, like you spell it out.
Yeah, okay.
Good
That's
point.
a good point.
Okay. There we go.
Because we get it.
Here we go. Welcome back to the Best of Investing. Edward Brown here along with Patti Cohen and our special guest, Richard Davey. Third trivia question. Who was the only clean-shaven president in the 50 years between Grant and Taft?
Don't know.
Cricket.
Okay, will this give you a hint? He was assassinated.
Really?
William McKinley.
Oh.
If you think about his face, he didn't have any facial hair.
Oh.
Kind of a weird question. Okay, so Patti, you and I are, yeah, that's okay. It's just a headphone. Sorry. As long as you can talk in it and I can see it on here, we're okay. All right. So Patti, you and I are investors in the Pacific Private Money Fund, and I don't know if you saw your last distribution, but the annualized yield was about 8.25%.
That's awesome.
I like that.
That's
I mean,
awesome.
it usually fluctuates between 7.6 to 8%, but last month we were very happy.
I know.
Happy indeed.
I'm thrilled. I mean, it's a really solid company. Hopefully, really, as long as real estate's solid, but their loan to value
Well,
is
that's
so
the key.
strong.
Exactly. Yeah. I mean, if it'd be one thing if you're 90% loan to value and you say, well, real estate always goes up.
Right.
But that's not what they do. The average loan to value in the fund is only 56%.
Oh, it's 56. I was going to say
56,
like 70, 60.
No. They do some loans at 70, but that has to be kind of a special situation. Most of the loans are in the 60s, and they have some in the 40s. And so, that's why they have very little default.
Yeah. That's
So
great.
Patti, how far did the real estate market go down in like Marin in 2008, 9.
Oh,
It
I
wasn't
mean,
40%, was
No, it's like 25. wasn't it?
it was, but it depends on what segment and where.
it? Sure.
Like some condos in Nevada, like were, 250, and then a gardener making no money bought it for 500, and it went back down to 250.
Oh,
So like it depends where.
Huh, okay.
And some of the really, really high end stuff went way down. So yeah, but we were, like the Bay Area likes to believe, oh, we're immune, we're insulated. We're really not.
Yeah.
Well, we weren't, but yeah. So and then you take like Texas, Nevada, Las Vegas,
Yeah, Las Vegas, Phoenix.
Palm Desert. Those places took the biggest hits.
Yeah.
Arizona, parts of Arizona. Yeah.
Gotcha. Yeah. Partly the overbuilding, and the thing is, in the Bay Area, the regulations they don't let you just. Yeah.
Yeah. And like Ground Zero was Stockton, Fresno, that whole area. What made people think that they could buy something in cow country that had nothing going for it? Sorry out there,
Yeah.
but and that it was going to go doubling. And so at the very end, when I saw, I have a friend that does like 100 deals a year in Stockton, and she said what she saw at the very end was just Bay Area, San Francisco agents coming out there with their clients, mostly, Asian people just wanting to, like Chinese buyers just wanting to get in there.
That was
It ended.
the beginning of the
They
end.
bought at the peak. At the end, what I saw a lot in Marin was a lot of, gardeners, and it just
Well, the movie The Big Short was actually pretty accurate.
very,
Yeah.
very.
It's funny to see how some of these movies actually do a good job with, portraying
Yes.
exactly what happened. So anyway, yeah, but back to just for a minute the Pacific Private Money. So they pay monthly distributions, yielding between 7.5 to 8.4%, and you can either reinvest the distributions or take them on a monthly basis.
So awesome.
Yeah.
I mean,
So-
try doing that. Go to a bank. What are you going to get? Like 1/4%?
Yeah, some are paying a little bit more
Or
than a
one.
quarter. Yeah.
Yeah. 1%. I don't even know what they're paying. I don't even look. It's like, what's the point? So
No, it's
I'm
got that.
thrilled with
Yeah.
Pacific Money. Yeah.
Pacific Private Money.
Right.
So yeah, check them out, pacificprivatemoney.com, or call them 415-883-2150. A couple more things you want to share with us?
Yeah, just on the topic of buying a home or being ready. Something I work with a lot of, millennials, people in their late 20s to 30s, buying their first home. They have a family now, or maybe they're planning to have a family. And you see, maybe it's because their parents were victims of the Great Recession, that they're shoveling as much money as they possibly can into their 401ks. And it sounds great on the surface.
Because of the pre-tax.
Yeah, you're getting huge tax benefits, and it's just great to save.
And
But-
some employers have matching funds too.
Yeah,
Matching
that's free
funds.
money.
It is free money, but there's a cost, and that's the liquidity. So I'm seeing lots of people around my age trying to buy a home, and they have lots saved, $100,000, $200,000, but it's all in their 401k,
But
which
there are some that you can actually temporarily borrow for
you
a
can.
house, right?
Yeah.
Temporarily.
It's not going to get you very far in the Bay Area. Let's just put it that way. And it
Yeah.
exposes you to huge risk if you're laid off with an outstanding loan. What's due is taxable income.
Can you roll that into an IRA?
You
mean,
can
yeah,
roll a
how's
401k into an IRA,
Yeah,
but
so what about the loan though?
not sure about the loan, but when
Huh.
you're terminated, that outstanding loan balance can become taxable income. So, and it's a max of 50K.
Yeah.
So again, in the Bay Area, 50K is not a down payment in most places.
Yeah.
So just a point to really hit home for young real estate buyers out there is they have to save liquid and they have to start early.
Yeah, because you can take the money out as long as you put it back within 60 days
Mhm.
without a penalty. But 2 months go
That's
pretty
pretty
darn
risky.
fast.
Yeah.
So let's say
We'll get
some
burned.
industrious millennial is 35 years old and they put $200,000 into their 401k and they want to buy a house, and then they decide to take it out because they have no other funds. What are the penalties for doing that? Like, what's the downside of that?
Yeah, I mean, you're going to pay ordinary income tax and a 10% penalty. If you're,
And franchise tax board, what, 2.5%?
they stack up, and it's going to be for a lot of high income earning people, you're going to be north of 50%.
Yeah.
That's
So
from the government.
essentially, probably they would, depending on how long they had that 401k and the interest they made on it, but probably they'd be, if they looked at the whole investment, they'd be coming out with less than what they started.
Yeah,
So for sure, if
For
it's
sure.
with less than a year.
and if you're assessing the whole financial decision as a whole, do I buy this house? I don't think that it's very easy to justify buying any house if you have that risk on the table.
Yeah.
So you've got to be putting money away into a non-retirement account, be it a bank account or investment account.
And
Just get ready.
Just pay the taxes.
Just be ready. Yeah, you can gets into a much deeper discussion, Roth IRAs to a certain extent.
Mhm.
But you should just be saving money.
But that's the thing, if you put it in a Roth IRA and you take it out early, you still have that problem.
It could be a long conversation, but your basis in the Roth, meaning the money you've contributed to it, can always be pulled out. Believe it or not.
Yeah, because the parties you're paying the taxes on it first.
Upfront, yeah.
Okay, so that's the thing, is you can pull money out of the Roth IRA, you can pull your basis out
Correct.
without penalty.
Correct. So if you put 100 grand in over 10 years, you couldn't do that really. But if say you could and it's grown to 150, you can only pull 100 out without penalty before your retirement age. So go back to non-retirement accounts are the best way to buy a house, in my opinion.
For buying a house, okay.
Mhm.
But other than that though, if you've already owned, let's say you already own your house,
Mhm.
then do you generally advise people to put as much money in their retirement as possible?
I'm a big Roth IRA fan.
Yeah.
I think that long term, if you look at the fiscal situation of our country, it pays to pay the tax now versus in 30 years when taxes will likely be higher. We're at low
Now,
tax.
here's a philosophical question for you.
Sure.
Is do you think that the Congress will change the rules at some point and say, yeah, we know we told you it was going to be tax free, but we need to put the
You'd have riots in the streets.
Right.
Well,
But,
there were no riots when they taxed Social Security. There were
Sure.
people who were upset, but that happened.
This is a account by the very nature of it. It's
Sure.
supposed to be pulling.
Oh yeah,
tax.
listen, I hear you, and I hope that they don't tax it, but Congress does whatever Congress does.
They do, and it's one of the most overly and unnecessarily complex areas of the tax code. CPAs stay away from it because you have to have special pension consultants run
Really?
retirement plans because it's too much liability because it's outside of.
Oh, yes.
So Congress should do something on that front.
Gotcha. All right, we have to cut to our last commercial break. There's no trivia question for this one, but don't touch that dial. We're going to be right back. It just started right over just a little tiny bit.
It's a rabbit hole. That's
Yeah.
if we talk about that stuff.
Well,
But one thing that you don't hear much about anymore is, and it would be serious riot in the street and affect so many people, is taking away that
home mortgage.
home mortgage deduction. Like
Yeah.
seriously, that's one of the reasons you buy.
Yeah, that would. I could see them doing what they did before with the home equity line. Like the first million or whatever.
Yeah.
I could see them doing something like that. Well, this is what happened many years ago. So this was in the early 80s, and I just got my master's in tax, and I was starting to do some research on some stuff. And I said, you know what? I was starting my business, and I said, they're going to start. I said they're going to start taxing Social Security. I said there's too much money out there. They need to tap. Oh, they'll never tax Social Security. I said, you watch, they will. The first 50%, and then the 85% if you have so much, right? And I said the next thing is, I said they're going to. Well, eventually they'll make it 100%. Okay, but I said at some point they're going to look at us and they're going to say, well, you don't need it. You have to qualify.
It'll be needs based.
It'll be needs based.
Oh God.
I could just, that's my prediction.
Well,
My other prediction is on Roth, so they're going to do something.
But
I know it doesn't seem, and again, we don't know.
Yeah.
This is all speculation.
Well,
Home
and the
interest
same with
deduction.
Medicare.
Yeah.
Medicare, like I don't need that, but I'm going to get it.
Yeah, exactly.
Yeah.
Yeah, I had a client who, her husband died in 1961, and she lived 101 years old until the year 2011 or something,
Wow.
right? So her husband probably put in maybe $3,000 in the system, and
Yeah.
she was collecting $1,000 a month for 30 years.
Wow.
Well, that's a great rate of return.
we'll talk
Wow.
about
She didn't
the
do
average male life expectancy when Social Security was founded was like
Right.
65.
Right.
Yeah.
You
Yeah, so
you're
50 years
actuarially
done.
expected to not actually collect.
Yeah.
So it's
Yeah.
just a silly, like it should be 75 to start Social Security
Yeah.
nowadays.
Because people are working longer too. I mean, turn of the century, 1900, the average life expectancy in this country was 47.
Oh, is that all it was? Wow.
Well, And then if you were a chimney sweep, it was like 15 years old.
Last fun fact, I just heard this on Armstrong and Getty, I believe, that life expectancy increased more in the last century than it did in all other centuries combined.
Makes sense.
Well, that makes sense.
Yeah.
I mean, I think
Once
that,
you go to biblical times, then you're,
yeah. I mean, I really think that, very soon people are going to easily be living, like soon, 120.
well, 100, and
25.
apparently that's the biggest, shift right now is people turning 100.
Yeah.
It's like one of the biggest, you have all these baby, actually that's before the
That's
baby.
that's baby boomers' parents.
Yeah.
And 90s were rare. The 90s was not anymore.
Yeah.
Yeah.
All
What
right.
are we gonna
so
talk about now?
we only have 5 minutes.
That's
Actually,
it?
we have less than that because I got my little ending thing here. So
Wait, we had 5 minutes. We had like 2 or 3 minutes.
about 3
3
and a half
minutes. 3 and a half minutes.
So anything?
I mean, I can pitch hard money all day over risk and bonds right now
Doesn't upset me at all if you do that.
I know.
because of the short-term nature.
Yeah.
And then we can pitch ourselves a little bit. Like
Absolutely.
Just the name.
Okay. Great.
Yeah.
Well, welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Patti Cohen, our special co-host, and our special guest, Richard Davey. Now, we didn't have a trivia question, but Richard, you were just mentioning off air something that you like about hard money, or private money, as they say.
Yeah, so this is an unsolicited endorsement of the asset class. You'll hear a lot of people talk about stock market bubbles right now. Everyone's worried about the stock market, but there's just as much risk, you could argue, in some bond investments.
If
So
rates go up, bonds go down generally.
exactly, and the longer the bond you hold, the more risk you hold, because your piddly little 3 or 4% bond that's 20 years is going to be really, really hard to sell when that same type of bond now coming out is earning 6 or 7.
Yeah.
So why does that relate to hard money? Hard money loans typically are short-term loans. So, and you're earning a arguably better interest rate, more like a high yield debt interest rate with great Bay Area collateral in most instances.
Yeah.
So I'm actually getting huge response from clients that they're interested in it. I'm interested in it for a bond substitute myself right now, because checks a lot of those boxes for reducing interest rate risk. You have
Well,
hard
and then
asset behind it.
you hit the nail on the head because of the short-term nature. The loans turn over on average about 9 months.
And that's
So-
going to mean higher rates if rates go up in the fund.
That's it, exactly. And it's not like, Pacific Private Money is saying, oh, you're going to earn 14% on it. They're not saying that. They're, it's 7.5% to 8%. And even some people, they go, oh, that sounds too risky. Say, well, again, like you said about the options, let's not just throw everything in one category.
Sure.
If somebody has $1 million house that's free and clear, and they have the option to buy the house next door at a $200,000 discount, but the catch is they got to close the deal in 3 weeks.
Yeah.
And so
Or even a week.
or a week, right?
It's
Okay,
a lot of money.
exactly.
Yeah.
Yeah. So it's like, there's no bank in the world that can work that fast.
Yeah.
Well, so where are they going to get, a good chunk of the money? Well, if they go to Pacific Private Money, they get a loan of 60% LTV. They get to buy the house next door at a big discount, yada yada yada. So you can't just throw everything in one fell swoop. You have to kind of look at it, each aspect of it.
Sure.
Okay, and before we cut out, again, Richard, how do people get a hold of you? Because specifically, there's a lot of financial advisors who kind of come and go, but not too many people really I won't say focus in, but know enough about the call option idea.
Sure.
And you got all kinds of interesting matrices on that, don't you?
Yeah. So real quickly, I was just sold on the concept when I looked at the performance of the S&P 500 covered call index against the S&P 500, and it's done better. So that was a starting point. But happy to talk to anyone about it. It's not anything that I am driven to sell. I'm an independent investment advisor. I'm not backed by companies that are having me peddle their product. I just believe in it. I put my money in it, my family's money in this strategy, and it's how I would invest other people's money currently.
Okay. How do people get a hold of you?
415-785-3778, or you can visit our website at ffgwealth.com.
That's an easy one to remember. And Patti, go again. You're a real estate expert. How do people get a hold of you?
Oh, it's Patti Cohn, COHN with Pacific Union. I'm at 415-722-4842 or bestmarinagent.com.
And there's a reason, because you are the best marine agent. Okay, hey, here's our thoughts for today. We're going to cut out. Here's our thoughts today. Okay. Falling down is how we grow. Staying down is how we die. And Milton Berle said, if opportunity doesn't knock, build a door. I mean, that's just kind of go, boom, go right through it. All right. Tune in next week to the Best of Investing. Why? Because we're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. All right. And that's a wrap.
Cool.
Nice and it was
Pretty easy, huh?
That was great.
Yeah.
So you've been doing this for a while?